This segment is about the rules of debit and credit. And as we start going into the accounting cycle, one of the first things you will do is analyze a transaction and then put the transaction into a T account, then a general journal, and then you're going to post it to a general ledger account. So let's look at what an account would look like. Here's an example of a standard account. Each account, cash, equipment, accounts payable, capital, and so forth, will have their separate form. And with these standard account forms, you will post all the transaction to these account forms. These forms are kept together in a book, which is like called a ledger. Multiple pages make the ledger book. When we look at this account form, you'll notice the title, account title goes at the top. Then there is a T, like you will be using to begin with. There is a left side and a right side. In these accounts, you will notice that the left side is called the debit side and the right side is the credit side. These indicate position, the location on the standard account form, and nothing more. So when we look at all the accounts, this is how they will be. So we have our basic accounting equation, assets equals liabilities plus owner's equity. On the left-hand side of the equation is assets. Notice in an asset account, it is increased on the debit side. Liabilities and owner's equity is on the right-hand side of the equal sign. They are increased on the right-hand side of their accounts. Now, owner's equity consists of capital, withdrawals, revenue, and expenses. Capital and revenue is going to increase the owner's equity. So they're increased on the credit side. Withdrawals and expenses decrease owner's equity. They are increased on the debit side. So as you are going through this chapter and starting to do transactions, you might want to create an index card with the rules of debit and credit on there. I will now illustrate an example of an index card. This is my card, and as you notice, it's just very simple. Up here is my accounting equation. Assets equals liabilities plus owner's equity. I have a T account to illustrate a standard form. Assets are on the left-hand side of the equal sign, so I have them increased on the debit side. Liabilities and owner's equity is increased on the right-hand side, which is the credit side. You will also notice they're on the right-hand side of the equal sign. Owner's equity comprises of 4 accounts: capital, revenues, expenses, and withdrawals. Capital and revenues increase owner's equity, so they are increased on the credit side. Now, expenses and withdrawals decrease owner's equity, so they are increased on the debit side. The side, you will notice that any account that is increased, that side is also called their normal balance side. For example, assets are increased on the debit side, so assets have a normal debit balance. Liabilities are increased on the credit side, they have a normal credit balance. Capital and revenue are increased on the credit side, they have a normal credit balance. And expenses and withdrawals are increased on the debit side, and they have a normal debit side. I would use this index card as you go through this chapter and the other chapters to help you understand the rules of debit and credit. Remember, when you do a transactions, go through the steps on how to analyze one transaction. We are now going to look at the transaction analysis, where there are 5 steps. We're going to go through each step individually and then look at a few transactions to help you understand how to use these 5 steps to analyze each transaction. The transaction analysis, step number 1, you're going to determine which accounts are affected. So you will read the transaction, then you'll determine what is affected: cash, rent expense, accounts payable, whatever. Step 2, you'll decide about where do these accounts, what category do they belong in? Are they an asset? Are they a liability? Or is it a part of owner's equity? Then you'll determine, will this account increase or decrease? What do the rules of debit and credit say? So look at your card that you've created and see, if it's an asset, it's going to increase. So I look at my card, it will increase on the debit side. What does a T account look like? So then you would put the amounts into the T account. So let's do some transactions together. Here's transaction A. Mia Wong invests $6,000 cash and $200 of office equipment in the business. Step number 1, what accounts are affected? Well, as I read that, I see she's put in cash, office equipment, and then since she's investing it, it would be the capital account. Step 2, what category? Cash is an asset, office equipment is an asset, and Mia Wong Capital is a capital account. Step 3 is, will this account increase or decrease? Well, if she invests $6,000 in the business, cash is going to increase. She's investing office equipment, so office equipment will increase in the business. And since Mia Wong is investing it, her capital account will increase. So then I look at the rules of debit and credit, and to increase an asset, it says it needs to go on the debit side. To increase an asset, debit side. To increase capital, it goes on the credit side. So this is what the T accounts would look like. Cash is going to be debited $6,000. Office equipment will be debited $200. And notice the 2 debits will equal the 1 credit, Mia Wong Capital, $6,200. The debits of a transaction must equal the credit. Since there are 3 accounts here, this is called a compound entry. So every transaction has to have at least 2 accounts affected, but there are some that have more accounts affected. Let's look at transaction B and go through the 5 steps again. August 29th, the law practice bought office equipment for cash. Accounts affected. I see office equipment and I see cash. Office equipment is an asset. Cash is an asset. So will these accounts increase or decrease? Well, when we bought office equipment, that increased. But we wrote a check and took money out of cash, so cash decreased. So you can have transactions where one increases and one decreases, or like transaction A, all 3 of them increased. We look at the rules of debit and credit. If an asset is increased, it's debited. If an asset is decreased, it's credited. So let's put them in the T account. Office equipment is debit $200. That was from transaction A. Now office equipment in transaction B is debited $500. Cash, however, in transaction B is credited $500. So our debit equals our credit. This transaction is called a shift. We're taking money from one asset and buying another asset. It's a shift on that one side. Transaction C. August 30th bought more office equipment on account. Accounts affected. Well, I see office equipment, but then I see these words on account. When you see the words on account, that means you're going to pay in the future, which is accounts payable. Category step 2. Office equipment is an asset. Accounts payable is a liability. Now, how will these accounts be affected, increased or decreased? Well, office equipment is going to be increased because I'm getting more office equipment. And then accounts payable is going to increase because I'm increasing the amount of money I will pay in the future. So they're both increased. The rules of debit and credit tell me, however, that to increase an asset, I have to debit that asset. To increase a liability, I have to credit that liability. So in a T account, C transaction would be debit to office equipment, credit to accounts payable. Our debits equal our credit. Transaction D. Here I have September 1st or the 30th, provide legal services for cash, $2,000. 2 accounts affected, cash, and since it's legal services, our revenue account is called legal fees. Cash is an asset, legal fees is a revenue. Now I'm receiving money, so my cash is going to increase, and I'm increasing the amount of money I'm receiving from revenue. So the rules of debit and credit state that when I increase an asset, it's going to be debited. When I increase revenue, it's going to be credit. So transaction D is going to debit cash, $2,000, and legal fees is going to be credited for $2,000. So I have my debit and I have my credit part of the transaction, and they equal. Transaction E. Here I have provided legal services on account, $3,000. So I have my legal services, which is legal fees, but I didn't receive the money, but I'm going to receive it in the future. So that becomes accounts receivable from our customers. We're going to receive money in the future. Accounts receivable is an asset. Legal fees is revenue. Now, we're going to receive money in the future, so that's going to increase our accounts receivable, and our revenue is increased. So the rules of debit and credit state that to increase an asset, you debit. To increase a revenue, you credit. So our T accounts will look like accounts receivable debited $3,000, legal fees credited $3,000. Debit equals the credits. Another transaction. Received $900 cash from clients for services rendered previously on account. So earlier we had our customers were going to pay us in the future. Now they are paying us. So since we are receiving money, we put cash, and since we decrease now the amount that our customers owe us, it's going to be accounts receivable. So cash is an asset, accounts receivable is an asset. Cash is going to increase because we're getting money. But now our customers don't owe us as much, so we are going to decrease the amount that they owe us. Rules of debit and credit, assets is increased is debited, and asset decreased is credited. So in the T accounts, we see cash is debited $900, accounts receivable credited $900, debits credit, and that transaction equals. So first step always in the transaction analysis is to decide what accounts are affected. Second step is to what category are those accounts. Then you must determine, does the account increase or decrease in the transaction? What are the rules of debit and credit for this? And then how would it look in the T account? So as you go through and do each transaction, again, I would use that index card with the rules of debit and credit, And I would go through these 5 steps for each transaction until you understand totally the 5 steps, and then pretty soon you're going to be doing them automatically.